Every story has a beginning and an end. Every story has a hero and a villain. Every story except the one about the unseen empire. BlackRock.
BlackRock. BlackRock. BlackRock.
BlackRock.
This massive corporation worth nearly $10 trillion has a beginning, but no end in sight. It's both the hero and the villain, and somehow it fights itself on every front. So, let's dive into the making of the most influential company ever built, which, according to many, rules the world. Rise of BlackRock. In the heart of New York City, in a modest single room, a group of 8 individuals gathered with an audacious vision. It was the year 1988, and amidst the hustle and bustle of the financial capital, Larry Fink, Susan Wagner, Robert S. Capito, Barbara Novick, Ralph Schlostein, Hugh R. Frater, Ben Golub, and Keith Anderson were setting the stage for what would become a financial powerhouse. BlackRock Incorporated. Their beginnings were humble. Armed with a $5 million bank loan and a shared dream, they embarked on a journey to provide innovative asset management services from a fresh perspective, one rooted in risk management. Their timing couldn't have been more perfect. The financial landscape was grappling with the aftermath of the savings and loan crisis, and the Federal Deposit Insurance Corporation was in need of a solution. Enter BlackRock. Larry Fink was the leader and visionary behind BlackRock, and he was an invaluable part of building up BlackRock to the mighty conglomerate that it is today. Lawrence Douglas Fink, widely recognized as Larry, has etched his name into the annals of financial history through his unyielding determination and remarkable resilience. Born on November 2nd, 1952, Fink's journey from humble beginnings in Van Nuys, California, to becoming the driving force behind BlackRock's success is a story of perseverance and strategic vision. Fink's educational journey led him to earn a BA in political science from UCLA in 1974, followed by an MBA in real estate from the esteemed UCLA Anderson Graduate School of Management in 1976. His academic pursuits laid the groundwork for a career that would eventually reshape the investment landscape. Fink's career trajectory, however, encountered a pivotal moment of adversity during his tenure at First Boston, a prominent New York-based investment bank. In 1986, Fink's department faced a staggering loss of $100 million.
We were taking bigger and bigger risks without the attended risk technology to navigate that risk. And in the second quarter of 1986, we lost $100 million.
A consequence of an incorrect prediction he made about interest rates. This setback, although significant, proved to be a catalyst for Fink's future success. The experience of losing such a substantial amount due to an erroneous forecast had a profound impact on Fink's professional perspective. This event not only underscored the volatility of the financial markets, but also fueled his determination to create a company that would incorporate rigorous risk management strategies into its investment approach. It was from this setback that Fink's vision for BlackRock began to take shape, one that combined financial acumen with comprehensive risk assessment. The FDIC recognized the potential in Fink's nascent venture and tapped BlackRock to oversee the assets of S&L institutions that had fallen under its control. It was a daunting task, but the team's unique approach to risk management, coupled with their cutting-edge technology named Aladdin, proved to be a game changer. Aladdin was not just a piece of software, but a manifestation of Fink's vision to transform how investments were managed. The name itself held an air of magic, as it gradually became the cornerstone of BlackRock's success story. By 1991, BlackRock's assets under management, AUM, had swelled to $9 billion, a testament to their innovative strategies and client-focused approach. but they were just getting started. The years that followed were marked by meteoric growth. In 1992, AUM reached $17 billion, and by 1994, it soared to an impressive $53 billion. This rapid ascent drew attention and set the stage for BlackRock's next chapter. In 1995, a pivotal moment arrived when PNC Financial Services Group acquired a stake in BlackRock Financial Management for $240 million. Skeptics questioned the wisdom of the move, but Larry Fink had a grander vision in mind. The strategic partnership with PNC allowed BlackRock to tap into a broader client base, seamlessly blending its institutional roots with a stream of retail clients. Fink's ability to foresee the potential synergy laid the groundwork for future success. But life is never without its challenges. The mid-90s saw the bankruptcy of Peabody, a defining moment that would test BlackRock's mettle. General Electric, the owner of Peabody, turned to BlackRock for help in liquidating the troubled company's $7 billion mortgage-backed securities portfolio. Fink's team rose to the occasion, demonstrating not only their financial understanding, but also their resilience in the face of adversity. The late 90s witnessed yet another milestone as BlackRock went public in September 1999. The initial public offering on the New York Stock Exchange marked a turning point, providing the company with the capital it needed to fuel its growth. By the end of that year, BlackRock's AUM had surged to an impressive $165 billion, a testament to the trust that clients had placed in their unique approach. The new millennium ushered in a wave of expansion and innovation. In 2000, under the guidance of Charles Halleck, BlackRock unveiled BlackRock Solutions, an analytics and risk management division. This move highlighted their commitment to staying at the forefront of technological advancements in the finance industry. But perhaps one of the most significant moments came in 2009, when BlackRock became the largest asset manager worldwide, boasting an AUM that showcased their dominance on a global scale. This milestone was not just the result of financial prowess, it was a culmination of years of dedication, hard work, and a commitment to redefining the industry. The subsequent years were marked by strategic acquisitions that further solidified BlackRock's position as an industry leader. The acquisition of State Street Research and Management's holding company and the merger with Merrill's Investment Managers division showcased BlackRock's appetite for growth and innovation. These moves not only expanded their client base, but also brought new talent and expertise into the fold. As BlackRock expanded, so did their influence. Their iShares business became a driving force, accounting for a significant portion of their total assets under management. Their commitment to environmental, social, and corporate governance (ESG) issues positioned them as industry pioneers in responsible investing. Today, BlackRock stands as a true giant in the world of finance. With over $8.59 trillion in assets under management as of December 31st, 2022, BlackRock has become somewhat of a folk legend. It's no wonder Larry Fink's brainchild is the world's most powerful and influential company today. BlackRock today. In the aftermath of the 2008 financial crisis, it was a time of upheaval, uncertainty, and opportunity as financial institutions scrambled to navigate the treacherous waters of economic turmoil. Amidst this chaotic backdrop, a remarkable story was unfolding, one that would see the rise of a financial titan that would forever change the landscape of global finance. Barclays, a venerable British bank with a storied history, found itself at a crossroads in the heart of this tumultuous era. The financial crisis had left scars that ran deep, and Barclays was in need of a strategic move to raise capital and bolster its position in the aftermath of the storm. As the financial world held its breath, Barclays embarked on a daring journey that would have far-reaching consequences. In a move that would prove to be a masterstroke, Barclays made the audacious decision to sell its global investors unit. This treasure trove included the jewel in the crown, iShares, a powerhouse in the world of exchange-traded funds, ETFs. Enter BlackRock, an already shining star in the financial firmament, with ambitions as towering as the skyscrapers that grace the world's financial capitals. The deal, struck on February 2010, saw Barclays sell its global investors unit, including iShares, to BlackRock for a staggering $13.5 billion. But this transaction was no ordinary exchange of assets. It was a pivotal moment that would shape the future of finance. With this acquisition, BlackRock wasn't just acquiring assets, it was harnessing the power of ETFs, a revolutionary investment vehicle poised to transform how investors approach the market. As the dust settled on the historic deal, BlackRock found itself in possession of a true gem, iShares, a game-changing business that specialized in offering exchange-traded funds. Now you might be wondering, what's so special about ETFs? Well, hold on to your financial hats, because here's where the magic lies. Imagine a financial instrument that combines the best of both worlds, the flexibility of individual stocks and the diversification of mutual funds. That's the essence of an ETF. It's like having a basket filled with investments, from stocks to bonds, all neatly packaged into a single tradable unit. And iShares was at the forefront of this ETF revolution. With their low costs, liquidity, and ability to track specific indices, ETFs quickly captured investors' imaginations. They offered a new way to access a wide range of assets, from stocks to commodities, all while providing the ease of trading that investors craved. With iShares under its wing, BlackRock became a powerhouse in the ETF landscape, wielding a tool that would reshape the way people invested. In the years that followed, BlackRock's meteoric rise continued unabated. So, what exactly does BlackRock do with its colossal fortune? Imagine them as the ultimate conductor of a financial symphony, with a diverse array of instruments at their disposal. Their business model hinges on serving a spectrum of clientele, from official entities to small investors, with operations spanning over 30 countries and clients in more than 100. They're like the Pied Piper of finance, leading a global parade. But their true prowess lies in their value propositions. The BlackRock brand isn't just a name, it's a symbol of trust and excellence in asset management. With a slew of services that span equities, fixed income, options, and more, they're not just dealing in numbers, they're crafting financial melodies. Of course, where there is a melody, there is also someone dancing. When the COVID-19 pandemic struck, financial markets were thrown into disarray. Governments and central banks scrambled to stabilize economies, and in this chaos, the Federal Reserve turned to BlackRock. The mission was clear: manage two crucial corporate bond buying programs, injecting liquidity and stability into a shaken market. BlackRock's role in this scenario was akin to a financial conductor, leading an orchestra during a tumultuous performance. By overseeing these programs, BlackRock helped ensure the functioning of corporate bond markets, a critical component of the global economy. This collaboration highlighted BlackRock's ability to provide stability and expertise during times of crisis, further cementing its influence as a key player in the financial realm. Access to China's financial markets was a coveted prize, In an era of increasing globalization, BlackRock managed to secure this opportunity by becoming the first global asset manager approved by the China Securities Regulatory Commission. This achievement was more than just a feather in BlackRock's cap. It was a testament to the company's global reach and influence. By gaining access to China's market, BlackRock demonstrated its capacity to navigate regulatory complexities and establish a significant presence in a major global economy. This move wasn't just about investments. It was a strategic step that showcased BlackRock's prowess in adapting to new environments and seizing emerging opportunities. BlackRock's influence extends beyond geographical boundaries to encompass a diverse range of investment strategies. A prime example is its approach to India and China. While BlackRock lowered its investments in India, it simultaneously increased its focus on China. This calculated move demonstrated the company's ability to pivot and adjust its investment strategies based on market dynamics. This balanced approach reflects BlackRock's role as a strategic player, carefully evaluating opportunities and risks across different markets. The company's decisions aren't merely financial transactions. They're a reflection of its deep understanding of global trends and its commitment to maximizing returns for its clients. As the curtains fall on the various acts of BlackRock's influence, one thing remains clear. This financial giant is far more than just a participant in the global financial arena. It's a leader, a strategist, and a partner to governments, institutions, and investors worldwide. BlackRock's impact isn't confined to spreadsheets and balance sheets. It's felt in the intricate movements of financial markets. And just like any financial behemoth in history, BlackRock has also become the center of conspiracies and controversies. Some justified, others not so much. Impact and controversy. In the dazzling world of finance, few names evoke as much intrigue as BlackRock. And how can it be otherwise when the company is proven to be a financial colossus that seems to occupy both the spotlight and the shadows? It's a tale of influence, power, and a dash of controversy that has the financial realm buzzing. In 2010, Ralph Skolstein, one of BlackRock's founders, coined the term that still resonates today: the most influential financial institution in the world. With assets that rival small countries' GDPs, BlackRock commands attention and respect across the global financial landscape. Its sheer size and extensive reach have led some to dub it the world's largest shadow bank, a term that hints at both its power and its enigmatic nature. Yet with great power comes great scrutiny. In 2020, US representatives proposed a bill aimed at reining in BlackRock and other shadow banks, raising questions about the extent of its influence and the potential risks it poses. Some voices even suggested that BlackRock's scale warranted it being designated as too big to fail, a classification reserved for institutions with the potential to cause systematic disruptions. BlackRock's influence isn't confined to its monetary might alone. It extends to its role as a major shareholder in numerous publicly traded companies. Picture a grand theater where each company represents a performer, and the shares they issue are the notes of a symphony. BlackRock's portfolio, spread across these companies, comprises a chorus of notes that can crescendo into powerful influence. Its holdings are not mere numbers on a balance sheet. They represent a stake in the success or struggles of various industries. BlackRock's vast holdings have led to it being counted among the top shareholders of some of the world's largest corporations. This concentration of ownership, while formidable, also raises concerns about anti-competitive practices. Critics argue that when BlackRock becomes a major shareholder in competing companies, it might impact market dynamics and potentially hinder healthy competition. And rightfully so. Still, BlackRock claims that they have forbidden their companies from communicating. Or as they put it, they've built a firewall between them. Charming, but not too convincing. Still, most countries have a regulator that can interfere when a market is in potential danger of becoming a monopoly. In the US case, that's Sherman Act Section 1. So since the judicial system has not taken any action against BlackRock, we may consider that they are actually enforcing their firewall strictly. As BlackRock waltzes through this complex landscape, it must navigate a tightrope of interests. On one hand, it aims to generate returns for its clients, the owners of the assets it manages. On the other hand, it must consider the ethical and fiduciary responsibilities it has as a steward of these assets. This dual role highlights the delicate balance BlackRock must maintain between financial gains and ethical considerations. One of the key critiques BlackRock faces in this dance is its potential to exercise shareholders' votes on its clients' behalf, without necessarily involving them in the decision-making process. While this practice might be in line with its contractual agreements, it raises questions about the extent to which BlackRock truly represents its clients' interests and whether it might pursue its own agenda. In response to these allegations and concerns, BlackRock has emphasized that the shares it holds are ultimately owned by its clients, not the company itself. It maintains that the interests of these clients guide its decisions and actions. However, the broader discourse raises questions about transparency, the balance between market influence and fiduciary duty, and whether the dance of ownership needs new choreography. The dance of ownership, with BlackRock as a lead dancer, is a dynamic interplay between financial power and market influence. Yet it's not the only controversy surrounding this giant. No discussion of BlackRock's controversies is complete without diving into its investments in contributors to climate change. With its vast holdings in coal-fired power stations and fossil fuel reserves, the company has faced heated criticism for its role in environmental degradation. Campaigns labeling BlackRock as the biggest driver of climate destruction on the planet highlight the profound impact of its investment decisions. To its credit, BlackRock has made efforts to pivot, vowing to shift towards environmental sustainability and divesting from coal-related assets. However, critics argue that these moves are insufficient, pointing to declining support for climate risk disclosure resolutions as evidence of a lack of commitment. BlackRock ventured into environmental, social, and corporate governance (ESG) investing to mitigate this disastrous image. As you can imagine, this adds a layer of complexity to their narrative.
We're using now more renewable energy in the United States than coal.
As it seems now, they're playing both sides. On one hand, it's lauded for advocating for positive change by encouraging companies to embrace sustainability and diversity. On the other, critics question the depth of these efforts, suggesting that they might be more about marketing than meaningful transformation. In 2017, BlackRock set the stage for its ESG journey by expanding its commitment to environmental and social issues. This marked a significant departure from the conventional focus solely on financial returns. As the effects of climate change became increasingly evident and societal expectations shifted, BlackRock recognized the need to integrate ESG factors into its investment strategies. The journey began with letters penned to CEOs and shareholder votes in collaboration with activist investors and investor networks. This proactive approach sought to promote sustainable practices, hold companies accountable for their environmental impact, and champion gender diversity on corporate boards. BlackRock's influence as a major shareholder enabled it to push for changes that aligned with its evolving ESG philosophy. In a dance between criticism and defense, BlackRock's stance on ESG investing continues to evolve. Some former insiders have labeled it a dangerous placebo, while its founder, Larry Fink, asserts that ESG is not about being woke, but rather about conscientious capitalism. The company's fluctuating relationship with ESG showcases the ongoing balancing act between genuine progress and public perception. This is not the only topic where BlackRock plays both sides. BlackRock's global ambitions have led it to countries like China, where it became the first foreign-owned company allowed to operate a wholly owned business in the mutual fund industry. While this venture signals new opportunities, it also raises questions about BlackRock's motivations and its role in international power dynamics. The company's ties to governments and political figures have triggered debates about its involvement in national affairs. Allegations of cashing in on reconstruction efforts in Ukraine and accusations of cozy relationships with central banks fueled speculation about BlackRock's broader influence beyond finance. As we draw the curtains on this exploration of BlackRock's impact and controversies, it's clear that this financial giant is more than just numbers on a balance sheet. It's a force that shapes markets, economies, and even public discourse. From its towering influence and concentration of ownership to its ESG endeavors and climate change commitments, BlackRock's story is one of complexity, contradictions, and constant evolution. But hey, when you're worth nearly $10 trillion, getting your own lore and mythologized overlord status is just a part of the game. Just ask the Rothschilds. Care to learn more about the guys who ruled the world before it was cool? Just click on the video to your left.